Welcome to Trade with Conviction. No noise, no filler, just what's really moving in oil, freight, and everything trading in between. I'm your host, June Go. Very happy to have Neil and Abhishek here today. Welcome, guys.
Hi there.
Hello, everyone.
A peace deal or not, China exporting products or not, gasoline cracks smashed. We will all unpack them today in today's episode. Let's start with the market headlines. Can we start with Neil?
We can. I mean, we've got a lot to unpack today, obviously, and Abhishek, you're going to take off a bit more detail on this deal, I guess. But it is a reported deal of some sort. To put it bluntly, as we all know by now, it remains very binary in terms of the headlines. So the price goes up when the deal is off, and the price goes down when the deal is on, and nobody can really judge in a very safe way that's tradable what's going to happen in the next 24 hours. There has been a joint statement. It's under review. As far as I can see from reading between the lines, it doesn't really involve the US officially at this stage. It doesn't necessarily mean that Iran intends on restoring full flow through the Strait of Hormuz. And the sort of statements coming out of the US camp yesterday, Trump said he'll see what happens. Vance said negotiations are going to be very messy. I personally don't see this kind of clearing up anytime soon. I mean, increasingly there's talk of the midterms. Increasingly, Trump has been talking about oil companies making too much money, about gasoline prices being too high. I think there'll be a kind of muddling through where we get this kind of on-off signaling for a deal, trying to keep oil prices under pressure, trying to keep gasoline prices under pressure, heading into the midterms, but kicking the meat and bone of the deal down the road in terms of, the final management of the strait and the final rules about nuclear program in Iran, keeping that till after the midterms. So I don't personally see any resolution that we can really trade for a long time yet, actually. What do you guys think about that?
I also think that the fatigue that the market is facing from just on off is really hitting everyone. The price reaction nowadays is really muted. I'm seeing less interest from people to talk about whether the peace deal is real or not at this point of time. So it's really hard to trade this market now.
So what I think it is as good as a coin flip, a 50-50% probability whether the deal will go through by end of the week or not. We have heard about the agreement, but it is yet to be signed. And finally, nobody knows what are the details, whether there will be any toll, whether who will control the incoming vessels, outgoing route. So all those details are still murky and people are on a wait and watch mode to see what comes out.
Yeah, I frequently think about a statement that someone made to me, one of our clients. He basically said, I'd given up a long time ago trying to figure out the crystal ball of the politics of this whole thing. And all I'm doing is counting the barrels. And if that's what you're doing just now, it actually still looks kind of bullish, right? Because the Strait of Hormuz flow remains quite depressed. The Iranian tankers are piling up, and the Houthis are coming out and they've targeted another ship in the last 24 hours in the northern Red Sea. And I think that's something that will continue. I mean, I said this when a few weeks ago the Houthis came out and said they were going to target Saudi flows, basically. I said it wouldn't make sense if they allowed massive redirection northwards. Right, so I still think it makes more sense that the Houthis try and really reduce Yanbu flow altogether, including via the northern route. And if you look at those things, it's actually quite bullish.
Yeah, I mean, Neil has pointed out the major headlines which is floating around the market, and we left off yesterday with the oil market whiplashing between optimism over a possible Hormuz deal and a fresh Houthi attack claim. Now we have a negotiators saying that they have reached an agreement on a proposed route for shipping through the Strait of Hormuz. Exact details, as we discussed, are not clear, but a few reports suggest that Tehran would oversee inbound shipping close to Iranian coast, while outbound vessels would be routed through Omani waters. On paper, that could provide a framework for restoring safer tanker movements through Hormuz. But the market has good reason to remain cautious because we have already heard twice. Until there is a signed agreement and evidence that vessels can move safely, the risk premium cannot disappear completely. Also, Iran doesn't want to restore full traffic because that is a big leverage for them strategically. So it needs to be seen how it goes. And at the same time, what Neil mentioned, the blockade is visibly putting pressure on Iran itself. which may explain some sort of urgency around the negotiation. Around 50 laden Iranian tankers are now reportedly idling across the coast, compared with 36 when the US blockade resumed on July 14. And this disruption is not just limited to Middle East. Kazakhstan main export route through the CPC terminal on the Black Sea remains unreliable. We have seen on and off the loading and then again stoppage of loading. The terminal has repeatedly opened and closed this week because of safety concern and a shortage of tankers owners willing to take that risk. In the United States, this week's inventory data delivered a mixed signal. Commercial crude stocks recorded a surprise build, but gasoline and distillate inventories declined again and remain well below their 5-year averages. More on this when we cover the EIA stats.
All right. Any major developments on the product side?
Yeah, on the product side, we were discussing last week in a podcast that what will happen around the Russian export ban. And now they have come out and extended its product export restriction through January 31st, 2027. But the detail matters because from September 1st, export of diesel, marine fuel, and gas oil by producer will be exempt from the restrictions.
Yeah, we'll see on that one. I mean, there's definitely if you look into the developments around the Ukraine war just now, one of the big changes is that there is an increase in this kind of tit for tat escalation. And one of the big changes has been that the Ukrainians are running out of basically ballistic missile interception capabilities. And there's been whole chat about the Patriot missile system, the US, and reading between the lines. The commentary is that the US is also running potentially a bit low in their own capabilities, given what's been happening in Iran. So Ukraine is not able to defend itself from the Russian ballistic missile attacks. And Zelensky has said himself, like, basically the response to this will be increasing the scale of Ukrainian attacks on Russian energy infrastructure. And you saw there was Yaroslavl got attacked last night in a big way. I think there's a high chance that over the next few months, Russian ports are increasingly attacked. Refineries will be attacked anyway, and this sort of switch to attacking tankers also in the Black Sea will continue. And that's relevant also for CPC probably. So I would not be surprised if we sit here in 1 month's time and see that the Russian diesel ban has actually been extended in full for all products essentially. But let's see.
Yeah, interesting. So it needs to be seen how it goes. I mean, officially they have said from 1st of September, but if the drone attacks keep happening, and even if something goes beyond the refineries and ports are attacked, the supply crunch will remain. And yeah, that's an interesting point, Neil. However, on the east of Suez, China is moving in the opposite direction. Beijing has eased restrictions on refined product export for a second consecutive month, giving refiners more flexibility to ship barrel during August. We'll discuss this later, what it means for Chinese product export, and also look more closely at China's crude buying and refining strategy.
All right, thanks for that, Abhishek. Let's go back to EIA then. Neil, can you shed some light and updates over here?
Yeah, I can do a quick rundown because I guess we haven't talked about it too much. But yeah, there was a commercial build yesterday in crude. I'd say it's kind of in line with the trend of US commercial crude stocks stabilizing over the last few weeks. And I wanted to say I kind of expected this. I've kind of been calling this for a long time. And the big mover with this regard has been the state of US crude exports. And as I said many times, the US crude export number peaked at a massive 5.5 million barrels per day in May. And since then, it's just been dropping. And that's followed the tightness in inventory, particularly in Cushing. Has followed the US RB cons as well in a big way. And last week, US exports were 3.5 million barrels per day. 2 million barrels per day less than the peak. And so that's really the thing that is helping stabilize US crude stocks. And it means, commercial crude stocks, by the way, not SPR. And it means there's less crude available in the rest of the world. And that's pretty much as we expect. It looks slightly different if you look at the ARB setup today, TI into Europe, because we've had this big spike on Brent premiums, which we can talk about later. But overall, the US crude stock picture on the commercial side is being stabilized by SPR release and a lack of US crude exports. If you look on the clean product side, it's actually a slightly different picture for you guys. We've got high runs, but the clean product net exports have actually started to rise a lot. And on a 4-week average basis, it's now at the highest point of the year, even higher than the crazy high number we saw also in mid-May. And so net exports of the big three, gasoline, jet, diesel, are 1 million barrels per day higher than last year. So the US is kind of draining its own product system once again, having been quite stable on the stock level for the last few weeks. The US is draining again, providing more exports to the rest of the world. And that's something to think about with regards to margins, with regards to the US ability to provide cover for the world when Russian refineries are under attack and all this kind of stuff, as we've talked about, the tight capacity situation. So the implications are all US stocks are pretty much still low, particularly in Pad 1, if you look at products. And if you look on the product side, we've got maintenance ahead with products still low. And I think that's a bullish signal for products if we just take it outside of the picture of Hormuz just now.
Thanks, Neil. I want to cover a special topic today, the return of China, or maybe not yet. So we've seen over the last day reports showing that China has granted refiners approval to export 2.7 million tons of clean products to destinations excluding Hong Kong and Macau in August, compared to 2.5 million tons in July, with the option to roll over some of these allowances to September. In the same report, refiners can only export any inventory from fresh runs rather than drawing down from existing inventories. So it's very important for us to differentiate quotas versus actual export quantities. So when I looked at the pre-crisis levels of export data trends, I'm seeing that the MOGAS export volumes are more stable and range-bound compared to jet and diesel exports. So this suggests to me that MOGAS is the main balancing fuel that China needs to keep as security for domestic plants, whereas the middle distillates are the resultant barrels. On the crude side, China has shown that they are very geopolitically and economically sensitive on buying crudes. They were basically the dominant buyer during the fifth ADNOC tender for July and August loaders that was issued when the ceasefire was in place. They got very good discounts for those crudes. And they also benefited from additional crude escaping the Strait of Hormuz in June that will have arrived around second half of July into China, therefore allowing more refined products in the supply chain in China than the earlier commitment. However, when the US-Iran tensions flared up again in early July, China was not awarded any cargoes in the subsequent 6th ADNOC tender, and in fact were reselling some of the Upper Zakum cargoes that they bought at a good profit. Thereafter, they picked up some cargoes in the 7th ADNOC tender, which is the latest one, for August, September, and October loaders.
Yeah, I mean, I was thinking about that as well. I was reading that part of that story was about replacing those with Iranian volumes, and obviously the state of Iranian flows was very, very good, very strong in the second half of June and over much of July when we had basically almost free flow, and that I guess will not be so easy. Although there's always sort of floating barrels in the east for Iran, but generally speaking, Iran is now struggling to get its oil to market. And when I look at available flows data, because the story that you're painting just now is about whether Chinese crude availability is going to be high enough. And if I look at, or whether the runs will move higher because they're importing more crude, if I look at the flows leaving for China over this year, it looked like it was recovering a lot with the overall recovery in AG flow. But now that AG flow has declined, it looks like the total exports heading to China is actually declining again. So as you're about to say, it doesn't seem like they're wanting to import a lot more volumes than the rest of the world.
I think we can also take the signal from Saudi allocations. So for the August loaders last month, they were awarded about 10 million barrels, which is actually the lowest since the start of the crisis. So we need to see the upcoming Saudi term allocations for September loaders to check on whether they can sustain a higher crude purchasing signal in order to export more products. So I think the saving point is that the China-bound VLCCs from Yanbu are currently mostly able to sail through Bab al-Mandeb despite the Houthi threats, which lowers the risk somewhat for an even lower crude intake for August. On the WAF side, we haven't seen any pickup of activity from China. We are hearing reports that Russian crude is headed more into China via the Arctic route. Sinopec has come out to buy more ESPO crude as well from Russia. So overall, my view is that the actual refined product exports for July and August is currently more a result of that incremental runs from the Strait of Hormuz cargoes. The risk of Getting lower runs due to crude arrival uncertainties also may result in lower actual export quantity than the approved quotas for August. And I'm painting all this picture because it will come to the next point about cracks, right? We saw a crash in cracks, which I think has got to do somewhat also with the announcement of these product export quotas being a bigger amount from China. Neil, can you bring us to that part of the story on the gasoline cracks?
I mean, I think the vast majority of the crack decline is to do with the headlines, not to do with China, but with Hormuz. But just to add something to your story, I was reading a story yesterday about the fact that you have all kinds of funny stuff going on inside China that we don't understand, and that includes direct retail fuel sales of products that originate from Shandong and are not counted in official statistics via tankers, like road tankers and stuff like that. And the incentive to do that was quite strong when the prices were rising domestically. And so the story is that probably Chinese demand has been undercounted. Surprise, surprise, because, if you look at their crude import number declining by 50%, you could come to the conclusion just off that their product demand has somehow declined a massive amount, 20, 30%, which would be very bad for their economy. And so surprise, surprise, it's been undercounted, most likely. But that also means, they have a stronger demand internally than many might have assumed. And that has implications for their export numbers as well. So as you were saying, gasoline spreads and cracks, they've been smashed. I think it's mostly Hormuz, but also, particularly when it comes to gasoline, it's now almost mid-August. Gasoline often revolves around the summer story, right? Are we going to be tight this summer? And then when you start to head into winter, you get less people that are, really wanting to be super bullish, because it's not really the time of year. That's kind of how the gasoline market works a little. You also saw, up until last week at least, a stabilization in the US gasoline stock picture. Didn't look like it was drawing that much harder or that much lower. And I think you also have naturally higher supply coming in the rest of Asia. Look at the Japanese crude run picture, recovered to a 5-month high last week. So they've had enough crude availability for now, and that has an impact on the prompt market, generally speaking. I think that's about it. Longer term, we don't have too many stories. I still think it's very, very binary with the Hormuz story. So am I willing to be long EBOB spreads and cracks from here just because they've sold off so much? And I'm very sort of skeptical on the whole Hormuz story. Yeah, but would I put money on it? No. So I think that's basically what's driving the gasoline market, like with much of the rest of the oil market for the next few days.
All right, okay. What's the story then on RBOB and EBOB spreads? Where do you think also the TAA ARB should be?
Yeah, I'm not entirely sure right at this point. It's a bit mixed. So you saw that even ex-RVO, RBOB EBOB spread, or the TAA ARB, as we like to say, fell a lot since the end of July. And as I was saying, that kind of makes sense. The US stock picture seemed to have stabilized. Europe was looking a bit tight on, it's got all kinds of run issues related to the Rhine and stuff like that as well. The result of that has been that the ARA ARB, or physical RBOB ARB to New York, isn't open for anybody, blenders or refiners, all the way down the curve. But you still have, for example, heavy naphtha ARB is open into New York Harbor. You still have non-Jones Act Houston ARBs open into New York Harbor. So it seems like even though PAD 1 stocks are still low, they are managing to get by with this low level of official imports of gasoline blending components. And I just wanted to sort of go on a slight, tangent. I was looking into the Jones Act stuff because there's more kind of chat about extending the Jones Act over the last couple of days, the Jones Act waiver. You can actually look into the movements by tanker and barge between PAD 3 and PAD 1 and between PAD 3 and PAD 5 over the last few months in the EIA data. And PAD 3 to PAD 5 was limited. There was a tiny bit of flow, which there normally isn't. And to PAD 1 from PAD 3, there was a spike. So we're talking about in April and May, 1 to 200 kBT higher versus last year. So there has been more PAD 3 movement to PAD 1 internally via barge and tanker than we saw before. Maybe that's related to the Jones Act waiver as well. On the R picture, Houston has just about regained its position in Tuxpan, Mexico, over ARA again, and Florida. But it's a bit of a mixed picture for Houston for the rest of LATAM. And a big change there is going to be the fact that our MR rate outlook for the next 7 to 14 days looks very bearish because we have loads of vessel supply in the US Gulf. So it looks like freight will help the US Gulf or Houston regain some of its normal LATAM sort of destinations. And all in all, I'm not quite sure what that means for the TAR, but I don't see a very great trade. And as I say, I think a lot of this is also related to the headlines at the moment. And do I really want to be putting risk on basically what's relative spread between the US and Europe when we've got Hormuz potentially not reopening tomorrow? No, I don't see a good trade today.
Okay, how about East-West gas?
Again, it's the same thing. Again, it's priced much weaker, probably related to, the East-West has been behaving like that across various products, right? When you get a potential headline for Hormuz reopening, you tend to see a sell-off in the East-West on all kinds of products. And that's happened on East-West gas. And the notion is that you have more crude availability, you have more guaranteed runs in Asia because there's more crude coming out of the AG. And in that sense, it does look, if you had to put money on, it does look supportive for the East now because Singapore is pricing into lots of destinations in Africa, in the East, and also, there's some opportunities into Mexico as well from Singapore. So if you just look at the ARB picture there, it would look supportive. And you've had this big sell-off in East-West. And so if we get a surprise that says, okay, actually Hormuz is less open than everybody thinks, I think you can price up again. But again, it's blowing in the winds of the headlines. So I sort of refuse to take a very strong view, as you can tell at this point in time. Maybe if we recorded on Monday, we'd have better picture.
Okay. Well, I think NAFTA story is the same. We did see MOPJ cracks and spreads being pulled down due to optimism of the reopening of the Strait of Hormuz. But NAFTA East-West actually remained relatively steady because I think the East ultimately still needs NAFTA to feed the petrochemical units. What we have heard from the market that many of these units are already at minimum loading due to poor margins. So if they were to reduce any more intake, it would be the next tranche of outright shutdown, where of course most players are reluctant to go to. And I think when we look at the gas naphtha spreads and Sing 92 MOPJ, the correction was more on MoGas rather than naphtha. And this will now reduce the blend incentives for naphtha into MoGas blending. On paper, we see the Skita ups open to the east versus the west. However, with the Met refineries having concerns on crude availability with CPC loadings curtailed in the past weeks, I think we need to check whether the availability of these Skita barrels could become more scarcer in the market as well. Okay, let's move on to distillates. Abhishek, how has the market been behaving given all these headlines?
Yeah, so even the distillate market has shed some of its risk premium, although several other factors are also at play. Let's start in Asia, where the gas oil rally has lost momentum. Singapore's CPOC has narrowed sharply from around $9.5 per barrel to 5.5, and we had recommended going short last week, while the gas oil Brent crack fell from $62 to 55.
Is that mainly due to easing geopolitical risks, or is this the supply availability improving?
Yeah, so it's a combination of both. As we discussed earlier, China has approved August product exports with the volume potentially exceeding July levels. Although some barrel may slip into September because of limited scheduling time, South Korean refiners could also release some spot cargoes while the margin remain attractive. And as Neil was highlighting, Japan refinery runs have improved and are at a 5 months high. And from our perspective, the Sikka to Singapore arb is still technically closed, but it remains more attractive than sending barrels to Rotterdam via Cape. We have seen one Sikka cargo is already under loading for Singapore and expected to arrive mid-August. Together, these flows should cap Asian gas oil upside unless there is further escalation on the US and Iran. Now, flipping to West, where the story is very different. The diesel East-West remains deeply negative, reflecting a much tighter European market. Russia is the key driver. One of the major factor, I would say, export restrictions are removing meaningful diesel supply and are forcing buyers to rely more heavily on replacement barrels from India and US. Russian producers are currently expected to resume exports from 1st September, but that again remains uncertain. Further drone attacks, including strikes such as the recent one on the Saratov refinery, could extend the restrictions or keep at least the initial export volume subdued. And the situation is such, I think the Med is more tighter than the Northwest Europe because Russia, the Med is the major market apart from LATAM and to some extent WAF for the Russian cargoes. So in absence of those Russian barrels, somewhat replacement is coming from India and to US. But in looking at ARB, it make more sense from US ARB into Northwest Europe than Med, and as a result of which looks Med much tighter than Northwest Europe.
Well, if Europe is still tight, why have cracks and time spreads softened so sharply?
Yeah, thanks to headlines, the fading geopolitical premium is one main reason. CEPOC gas oil has fallen to around $45 per metric ton, while ICE gas oil Brent crack has corrected to 66 from a recent high near $82 per barrel. Another factor is a strong US arrival and workable arbitrage economics into the Rotterdam. Margins are around $5 to $7 per metric ton. New York, it is near $3, $3 to $7 per metric ton. And also from east of Suez, Yanbu flows are also viable. From our perspective, freight is a key enabler, as earlier Neil was mentioning. USGC MR availability has risen to 30 plus vessel versus a 90-day average of just 17. And while the inquiry remains slow, keeping pressure on TC14, the Houston to Rotterdam arb is already open by around $75 per metric ton for mid-August loaders. And if the freight has to weaken further, the arb should widen and draw more ULSD into to the Europe. Slightly bullish news which has come yesterday is that US inventory offered some sort of supportive signal. Distillate stocks fell by 3.5 million barrel to 107, led by mostly 5 million barrel draw in PAT 3, while implied demand rose to 3.9 million barrel per day. The surprising thing is, despite these draw in stocks, the heating oil spread barely moved.
Okay, then what about jet fuel? Are we seeing the same similar unwinding of risk premium?
Yeah, European jet has also started to unwind with the Northwest Europe differential falling sharply to around $76 per metric ton on Wednesday, as steady July arrivals from US, Nigeria, and few cargoes that have crossed Hormuz in the initial days of 60-day peace process, which couldn't last. Those couple of barrels or cargoes have arrived into Europe, and combined with US Nigeria exports have kept the imports steady into Europe.
Is this mainly about better arrivals or arbitrage economics are also improving?
It's both actually. Yanbu and West Coast India barrels are now workable into Rotterdam, while the decline in East West is improving the economics for even Far East to Europe flows. The next key factor is Hormuz, as we are discussing. The Arabian Gulf is Europe's main source of imported jet. So, a credible Iran Oman agreement and safer vessel transit could release more supply into Europe and push the Northwest Europe differential lower. In Asia, the same risk premium unwind is visible in regrade. SEP Singapore regrade has fallen to around negative $0.65 per barrel. Middle East supply concern ease and report of additional Chinese export is kind of increasing that supply optionality.
Is there any opportunities into Singapore?
Yeah, so Sikka to Singapore ARB is open for September delivery at roughly $1.75 per barrel on LR1 and 1.35 on LR2. And under sustained reopening of Hormuz would also improve crude availability for Asian refiners, reducing fears of run cuts and accelerate the removal of geopolitical premium. And from the seasonality perspective is also become less supportive. Peak summer travel demand should begin to fade from early September, while Japan's winter kerosene restocking season is still some distance away. So in summary, if, and it's a big if, the Iran-Oman agreement is finalized and safe Hormuz transit resumes, the risk premium could unwind more quickly across both Asian and European distillate complex. But until there is a signed and durable agreement, the market remains vulnerable to a sharp reversal. I see Neil smiling. I understand for gasoline, he was mentioning that there's not a credible trade ideas at the moment. And it's fair. I mean, being in cash is also a position. To me, also on the distillate side, I think as other people, this time is different, and we have been there a couple of times. I think there is a possibility of both time spread across east and west to go lower, but again, it is highly dependent and hinge upon how this week ends.
Just to clarify, Abhishek, I was just thinking to myself as you were talking, how many of our ideas have the caveat of if XYZ happens in the headlines, this will happen, and that's just the story of the year, and it's always
Yeah.
going to be like that until we get some resolution, because we can't seriously make a good prediction until we know what's happening in Hormuz. I was just thinking, and June, you're going to talk about it through crude as well. Like if XYZ happens on Hormuz, this is the outlook. It's impossible. It's really hard.
Yeah. Okay, then it's a good segue to crude. I'll do a quick fire round this time. The headlines that we had, the big one for the markets is that Murban futures will cease to exist. ADNOC had issued a statement on Friday that effective 1st November 2026, the pricing basis to determine the Murban OSP will be Platts Dubai plus an ADNOC announced diff, and this will be announced 1 month prior to the load month. This will align the timeline with how Saudi OSPs are also announced. IFAD, or i.e. the ICE Futures Abu Dhabi, has suspended trading in all ICE Murban future contract months with zero open interest and will suspend the rest once it reaches the scheduled expiry date or when the open interest falls to zero. So when I'm talking to my trader friends, they are all anticipating the Dubai liquidity to actually fall off as a result due to no more hedging flow from the ICE Murban side. The latest news, really hot off the press, the announcement from Saudi Aramco that they will cut the Arab Light oil price OSP for Asia by 50 cents per barrel in this round, fairly close to what the market was expecting. If I then look at the ARB's picture, TI ARB versus Houthis into Northwest Europe is open, but it's shut into the Far East versus Murban, with October TI Brent futures currently at minus $550 per barrel. I think the price signal for Murban versus WTI is very hard to call. It essentially, even if the ARB is shut, the refiners here will still buy anyway for supply security. So the key one that we can watch is more the TI to Europe. Anything you want to add here, Neil, on that point?
I was thinking more about the fact that a big part of that TI into Europe story, as I said before, is the fact that Brent diffs are so strong, which is partly binary on Hormuz again, as we've just been saying, and partly on CPC, which is also becoming binary, right? Because it's on and off and depends on the drone strikes and the tanker attacks. And it's becoming very, very difficult for a European as well to figure out what crude it should buy. Should it buy CPC? And is it going to overbuy? It's very expensive to overbuy just now. It makes life very, very, very difficult to plan. And I think there's actually going to be a version 2 of the CPC loading program because it's very, very difficult to call.
But CPC arbs are definitely closed everywhere, right?
The arbs are closed in theory into Northwest Europe, assuming you can get a cargo. It's closed into Asia. It looks even expensive into the Med. So yeah, there's no call to buy it. But if the loading program kind of normalizes, it's going to weaken, obviously, CPC.
So I think the beneficiary of this is North African crudes and West African crudes. They have been bidden up a bit more for the supply security angle into the Med. And also for India. So India has been bidding up some West African barrels. Essentially, their tenders for a few that we have seen excludes cargoes specifically from Strait of Hormuz and Red Sea. MRPL has bought 1 million barrels of Oman at the dated +3 level. IOC has bought 4 different crudes, Nemba, Saxi, Clove, and GNO. And I think another reason why India is starting to buy more West African crude, aside from the Hormuz closure situation, is also that they are facing Russian crude competition with China. So to fill the shortfall and basically for still relatively good margins, they will buy the rest of these alternative crudes up to a point where it becomes uneconomic. Right now, we haven't reached that level. At the start of this, remember, West African crude was really the cheapest barrel out there. I'll do another quick fire on fuel oil. This is a rehash of the webinar for those who missed it. Again, when we look at the Asian crude rerouting from moving those barrels from Yanbu, now going an additional 30 days via the Red Sea to Suez Canal and around the Cape of Good Hope, this will likely cause lower run rates and consequently lower residue production in September. The feedstock needs for a straight run will overwhelm bunker blending, i.e. we'll need the feedstock will pull more of these LSSR barrels and therefore supportive of Sing 0.5. We saw stellar conversion margins for Dangote into the Western refining kit, calling for a higher 0.5 east-west as Singapore attempts to pull the barrel back. However, we do need to rerun our econs a little bit because there was that gasoline smash correction overnight that could therefore pull down the value of 0.5. High 5 Singapore has widened recently and closely reflects our sulfur curve valuation. And in Europe, 1% seems relatively undervalued. ARB economics also reinforce this. Finally, the latest AG high sulfur fuel oil pricing suggests there's ample supply in the market. This is including Iraqi 4.5% crack ex-Fujairah. Anything to add, guys? In the markets, I think we pretty much covered them all. Yep. So That comes to an end to our podcast this week. For those who are in Singapore for APAC 2026, do join us for evening drinks on Monday, 7th September, and for a closed door breakfast briefing on Tuesday, 8th September. Reach out to any Sparta representatives to get the invites. Meanwhile, ignore the panic, trust the fundamentals, and as always, trade with conviction. See you all next week. Thanks, guys.
Bye. Cheers.
Thank you.